Okay, let's dive in. We're tackling something uh, really complex today, but fascinating too. Investing in China, specifically, this huge push they're making into AI. And you asked us to sort of sift through all the noise, right? The policy stuff, geopolitics, this whole AI imperative idea. Our goal, pull out the key takeaways so you get a quick handle on the opportunities, the pretty big risks, and the strategy involved. Because this isn't like your standard emerging market play anymore, is it?
Not at all. It's much higher stakes now. You've got state policy, global rivalries. It's deeply intertwined. What's really critical to grasp right from the start is that this isn't just about chasing, say, GDP growth figures. It's more about understanding the market structure itself, which is shaped by forces you don't see everywhere. The party's ability, or sometimes inability, let's be frank, to manage these big economic imbalances, plus this kind of hostile external environment. That really dictates success or failure for investors. The market there, it often feels like a tool of the state.
Not just a reflection of the economy.
Exactly. That's a key thing to internalize up front.
And that actually leads perfectly into something I found, well, frankly, astonishing. Here's where it gets really interesting. Did you know that even with China's pretty impressive GDP growth over the years, the stock market returns, often flat, sometimes even negative over long stretches? It's a real contrast. I mean, look at the numbers. The Shanghai Composite, okay, up maybe 12.9% over 5 years, modest. But Shenzhen, down over 9%. And the Hang Seng in Hong Kong, down about 1.3% in that same period. This decoupling, booming economy on paper, but the market not really reflecting that. It's crucial, kind of counterintuitive.
You've hit on a fundamental point there.
Yeah.
And if we connect this to the bigger picture, why does that happen? Well, a lot of it is down to the dominance of state-owned enterprises, the SOEs. They aren't always, let's say, laser-focused on maximizing shareholder value. Other priorities come into play. Plus, you've historically had inefficient capital allocation, and maybe most painful for investors, these sudden regulatory campaigns, they can just destroy value.
Right, out of the blue, seemingly.
Pretty much. So for you as an investor, it means GDP growth. It's almost a red herring. Doesn't reliably translate to market performance. What matters more is policy direction, corporate governance, capital discipline. It's a different game. And these sudden policy shifts, they create what people often call value traps.
Companies that look cheap, but just never seem to perform.
Exactly. Their earnings potential keeps getting capped by these bigger systemic issues or, the next regulatory wave.
So it's not just the SOEs directly. It's this whole policy environment acting like a constant drag.
But drag, or maybe a steering mechanism, depends on your perspective.
Okay, and that's compounded by some pretty serious domestic headwinds too, right? The property market downturn, for one, that's been severe, prolonged.
Yeah.
It's really hit household consumption, confidence, a huge internal weight.
Absolutely. And Beijing is trying hard to pivot, to move away from relying so much on real estate, shift towards high-tech manufacturing, boost domestic consumption. But that pivot, it's tricky, especially with this disinflationary trend we're seeing. Weak consumer prices, weak producer prices.
Which points to weak demand, right?
Yeah.
And maybe industrial overcapacity.
Precisely. And that obviously suppresses corporate profits, makes those value traps even harder to avoid.
So how does the state try and fight these forces? What's the visible hand doing?
The visible hand. It's very active. So in response, authorities have gone for what they call a moderately loose monetary policy this year, 2025. That means, cutting interest rates, lowering the reserve requirements for banks, trying to get more credit flowing.
Injecting liquidity.
Right. And complementing that with fiscal stimulus, things like these ultra-long special treasury bonds to fund big strategic projects, high-tech stuff.
But then there's the other side of that coin. The state giveth, the state taketh away.
That's the risk. Regulatory whiplash. Remember the 2020-2022 tech crackdown?
Oh, yeah. Wiped out an estimated, $2 trillion in market value?
Something staggering like that. A really chilling reminder that, look, political objectives can and often will outweigh shareholder interests. No question.
Yeah, it fundamentally challenges how you'd normally think about markets. So you've got these domestic issues, the heavy state hand. How does all that interact with the global picture, especially with the U.S.?
That's the huge overlay, the strategic rivalry with the U.S. It's not just noise, it's structural. It drives so much risk here.
Yeah.
Take the U.S. export controls on advanced semiconductors. They're explicitly designed to slow China down, particularly in AI.
Creating a bottleneck.
A critical one, almost like a technological siege in some ways. And this external pressure, it's probably the main catalyst shaping China's domestic industrial policy right now. It's forcing this massive state-led push for self-sufficiency.
So it really elevates AI from Just an economic goal to something much bigger, a national project. Let's really unpack this AI imperative then, because it seems absolutely central. For China, AI isn't just, another growth area, it's strategic. National security, future economic competitiveness, it's all tied up in AI.
Completely.
And they've put it down on paper, right?
Yeah.
The goal to be the world leader by 2030, that was back in the 2017 plan.
Correct. The New Generation Artificial Intelligence Development Plan. And what's fascinating is how they're going about it, this whole-of-nation strategy. It's backed by just unprecedented amounts of state-directed money, public sector funding alone, projected at maybe $56 billion this year.
Wow, $56 billion.
Yeah, and it's created this incredibly dynamic, hyper-competitive scene. You've got the established tech giants, Tencent, Baidu, Alibaba. They're kind of designated as the national AI team. But they're also competing like mad with this new wave of specialized startups. People call them the AI tigers. Companies like Zhipu AI, Baishuan, Moonshot, Minimax.
So it's state direction, but also fierce competition underneath.
Exactly. But the key insight, I think, is that the ultimate goal isn't just market innovation in the Western sense. It's national resilience, strategic autonomy. So investing in Chinese AI, it feels less like a pure tech bet and more, well, geopolitical.
That's a really important distinction.
Yeah.
But okay, all that ambition, all that state money, they still face that one huge obstacle, right? The hardware, the advanced GPUs, those U.S. export controls are a massive choke point.
Absolutely the biggest hurdle, no question. And this raises an important question. How do you respond to something like that? China's answer. An all-out, state-funded push to build its own
Self-reliance.
Total self-reliance. That's the core of what people are calling the sovereign AI stack. And this whole national project, it's being led by their designated champion, Huawei, with its Ascend AI chips. They're working super closely with the local chip foundry, SMIC.
So if you invest in this theme, you're essentially betting on Huawei and SMIC succeeding against the odds, against U.S. sanctions.
That's pretty much it. It's a direct bet on the success of this huge state-led industrial policy effort. It's about national survival for them in a way, strategic independence.
And are there ways for public market investors to get direct exposure to this besides, say, Huawei, which isn't publicly traded in the same way?
Yes, there are. You have companies like Cambricon Technologies listed in Shanghai. It's a leading domestic AI chip designer. And their revenue growth, explosive. Reported something like 4,348% in the first half of 2025. That's a direct result of this import substitution drive.
Wow, okay.
Then you've got others playing in the software and application layers like SenseTime, listed in Hong Kong, and iFlyTech in Shenzhen. Though the sources we looked at note they're facing profitability challenges, pouring huge amounts into R&D right now.
Right, building out those capabilities takes serious cash. But given the state backing, are these really normal market investments?
That's the thing. Their fortunes are just so tied to state policy and funding. It's less about outcompeting rivals in a free market and more about being aligned with Beijing's strategic priorities. They're almost instruments of state ambition, not just companies.
Which means that when we look at the big established tech giants, we can't just lump them together anymore, can we?
No, absolutely not. That regulatory crackdown, the maturing of their core markets, it's really forced them onto different paths. They have distinct investment profiles now.
That feels like a critical shift for anyone investing there. You need to be much more selective. Okay, let's break down the investment case for the big three then, starting with Tencent. What's the story there?
Right, Tencent. Its strength really lies in its diversity. You've got gaming, WeChat's social network dominance, fintech, cloud. It makes it pretty resilient. And their AI investments. That's seen as a major catalyst going forward. Especially for advertising analysts, are forecasting, 17.4% growth year on year, driven by AI ad targeting.
And integrating AI into WeChat itself must have huge potential.
Massive potential. Integrating their Hunyuan AI model could unlock completely new ways to monetize that huge user base.
Right.
Analysts are certainly bullish, something like 49 out of 53 rated buy or strong buy. So our recommendation here, it's a buy. We see it as the highest quality asset in the space, a core holding, really. For stability, the AI upside, and it's trading at a bit of a discount right now.
Sort of the anchor position in a Chinese tech portfolio.
Exactly. It gives you that strategic resilience in what's still a very volatile market.
Okay, makes sense. Now, Baidu, very different story, right? They've gone all in on AI.
Decisively AI first, and really they had to. Their old core business, search advertising, was declining, so their future now, it rests entirely on their AI assets. The Ernie language model, Apollo Go autonomous driving, their own Kunlun AI chips.
Their AI cloud business is growing fast, I saw.
Strong double-digit growth, yeah. But this transformation is incredibly capital intensive. It's hitting profits. Analysts expect earnings to drop maybe 17% in 2025 because of these heavy investments.
This is a big bet. How realistic is it for them? Can they pull it off?
That really is the multi-billion-dollar question for Baidu. Our take is a speculative buy. Why? Because it is the purest way to play China's state-backed AI ambitions in the public markets. Purest, but also highest risk, highest potential reward.
A high beta play, as they say.
Definitely. Expect it to swing harder than the market, up or down. It's a direct, though volatile bet on that whole sovereign AI stack succeeding, on Beijing pulling off its AI vision.
So if you believe China will get there with AI, Baidu's your horse, but buckle up.
Precisely. Brace for volatility.
Got it. Okay, finally, Alibaba. Another complex picture. Once the leader, now more of a turnaround story.
Very much a turnaround story. Their core e-commerce growth in China is pretty modest now. Intense competition. So it's positioned more as a value play. They're buying back tons of shares, nearly $12 billion in fiscal 2025. And the valuation looks low, around 8 times adjusted EBITDA.
But they are pivoting to AI too, right, with their Quinn model.
They are, and it's showing promise. Rapid adoption, apparently 6 straight quarters of triple-digit growth in AI-related revenue. So the AI part is moving.
But given the regulatory baggage of the competition, is this value play just another potential value trap, like you mentioned earlier?
It absolutely carries that risk, which is why our recommendation for Alibaba is a hold. Yes, it's deep value. But the uncertainty is significant. The regulatory history looms large, competition is fierce, there's geopolitical exposure. It's really only suitable for patient investors. Risk-tolerant ones who believe in the long-term turnaround and believe Beijing will actually let it succeed again.
And that's where things like the VIE structure come in again.
Yeah.
Adding another layer of complexity.
Exactly. The variable interest entity structure. It means foreign investors don't directly own shares in the operating company, but in a shell company with contractual rights. It adds legal and political risk, particularly in this environment. Underscores the whole unique nature of investing there.
Okay, so stepping back, what does this all mean for you, the listener, trying to navigate this? It feels like there are just layers upon layers of risk.
There are. We count at least 4 distinct layers you have to evaluate simultaneously. It's a lot.
Let's break them down first.
Geopolitical risk, that's number 1. Primary, most unpredictable, the U.S.-China tech rivalry. It's structural, it's not going away, so constant threats of sanctions, investment bans, market access issues.
Okay, layer 2.
Regulatory risk, those sudden sweeping policy changes we talked about, where national security or social stability just trumps shareholder value. That's a permanent feature, not a bug. And it's made worse by opaque governance like that VIE model.
Right, then layer 3.
Macroeconomic risk, just the basic risk that the economy stalls. If they fail to fix the property sector, fail to boost consumer demand, you could get stuck in low growth, even deflation. That hits corporate earnings across the board.
Even the tech stars.
Even them. And finally, layer 4, execution risk, specifically within AI. The whole grand strategy hinges on overcoming that semiconductor bottleneck. If they fail, all those billions poured into AI could become massive capital misallocation, a huge waste.
So given that incredibly complex, multi-layered risk profile, any money you put into Chinese equities needs to be sized very carefully, right?
Absolutely. Position sizing is critical here. And look, for risk-averse investors, a China agnostic or ex-China emerging markets fund is a perfectly reasonable alternative. Just sidestep the specific risk set.
But for those who are willing to take on these risks, what's the playbook? Can you just buy an index fund?
Probably not wise. For those willing to engage, active management feels paramount. Passive index investing could leave you overexposed to declining state-owned sectors or companies falling out of political favor. You really need to pick your spots. Focus on companies clearly aligned with national strategic goals, companies with financial strength, domestic market leadership, and crucially management teams who know how to navigate that opaque political landscape.
So forget traditional emerging market analysis. This is about reading the policy tea leaves.
To a large extent, yes. Understanding state capital flows, strategic mandates, it's a whole different paradigm.
Yeah.
Success here means leaving old EM strategies behind and embracing this new reality, dictated as much by state imperatives as by market forces.
Wow. Okay, this deep dive really underlines it. Investing in China today, it's not a simple growth bet anymore. It's a complex wager. A bet on the state's ability to pull off this massive tech and economic shift under huge pressure, both internal and external. And it's loaded with risks. Big ones, unpredictable ones. You need a serious risk premium for playing in this market. It really changes the definition of investing here.
It does. But, within that high-risk landscape, this clear policy-driven opportunity has emerged around AI, that all-in state push for AI self-sufficiency. It's created a powerful tailwind for certain companies. So the suggested approach we discussed, anchor with Tencent's resilience, add Baidu as that speculative AI pure play, and maybe hold Alibaba if you're patient and risk tolerant, looking for value. But the final thought maybe is this. As you consider all this, what does this new paradigm, this state-driven high-stakes technological race, what does it mean beyond China? For global markets, for innovation worldwide, that's something to really chew on.